Today we are going to be looking at TikTok University, seeing if TikTok is a good, reliable source for mortgage and real estate content. I've compiled about 7 different videos. Some are good, I think, and some are questionable. Some of these have gone viral mainly for the fact of, I think it just spurs a lot of conversation, but I am here to dive deep as a mortgage loan originator and see if everything here checks out. So let's get into the first video.
So this just happened at a bank and it really freaked me out. We were chilling in line. This guy has a freak out and he goes, "What do you mean I can't get approved for a house loan? I'm putting $100,000 down and I have another $250,000 in a bank account here at Wells Fargo. How can you not qualify me for a house loan when I'm putting $100,000 down and I have another $250,000, $250K in a bank?"
So it's either for one of two reasons. So for one, their credit history is so shot that they can't get a home loan. So like their credit score is maybe below 500. FHA's minimum is 500 to put 10% down, 580 for FHA to put 3.5% down. And then conventional loans are usually going to be 620 and above you have to be at. So it could be that or an income situation. So maybe he doesn't have a consistent income source. So it depends on what the situation is. Maybe he has an all cash business. Like for instance, the biggest thing that's a little frustrating as a loan officer is barbers and people in service that receive tips. If they get cash and they're not reporting that cash, which most of the time you're probably not going to do that because you don't want to have to pay taxes on that. You cannot use that as income. So people could technically be making a lot more money and feel like they're entitled to be able to qualify for a home loan because they know of the income that they are receiving. But on paper is what we have to go by as a loan officer. So one of those two reasons, but curious to see what continues to happen here.
This banker is just trying to tell him, like, "Sir, you don't qualify." We can't really understand the reason why, but
They can't understand the reason why. That's quite literally your job. If you're at a bank and you're talking to a loan officer or a banker, they should absolutely be able to tell you exactly why you cannot qualify. I'm confused. I feel like there might be something missing here, or that banker doesn't know what they're doing. Maybe it's their first day on the job. Who knows?
everyone in this line have a face of defeatedness, if that's even a word. Because if that person can't afford a home loan, what the hell chance do we have? We were a little extra nosy and we asked the man when he was leaving, damn near in tears. I said, "Hey, how big was your loan?" It was $400,000. He just wanted a $400,000 house. And he still didn't qualify.
Well, it's interesting because he's got $250,000 in savings and $100,000 to put down. So it sounds like he probably has 2 different accounts that coming out to be $350,000. It's got to be either a credit or income thing. But long story short, regardless of how much money you have in the bank, there are some private money lenders that will be able to give you a business purpose loan to purchase a primary residence. But that primary residence has to be for business purpose use and then usually requires a 35% down payment. So maybe you're operating your business out of your home, that would be considered business purpose. And it's a lot more lenient. It's privately funded. So like if I had $1 million in a trust account, which I don't, but if let's just say I did, that would be the equivalent of me lending private money. So there are options like that, but Wells Fargo does not have that option. And yeah, it's probably an income or credit thing. I wish they were able to explain that further to the guys so we wouldn't be so upset, but it happens all the time.
If you're thinking about buying a home in the next few years and you're not keeping up with what's going on with the Department of Justice and the real estate world, this is huge news and something that could cost the average home buyer roughly $8,000 to $12,000 in additional costs when they go to purchase. For those who have not been staying on top of what's going on, there's been a lot of lawsuits in the real estate world regarding commissions and sellers having to pay the buyer agent commissions on a purchase.
Yeah, this is interesting. I've been following this like a hawk because frankly, it will change the game if it ends up happening. So essentially, the lawsuit revolves around within the listing agreement, feeling like the sellers have been required to pay the buyer's agent commission. So it comes out of their pocket at closing and doesn't come out of the buyer's pocket. So what they're trying to do is switch that and put it in the buyer's side, and the seller only pays the listing agent, not the buyer's agent. It's going to create a listing agent only environment. So if that ends up being the case to where there's a buyer's agent fee that's being added, which buying a home is hard enough as is. If you're putting 3.5% down for an FHA loan, and then you have another 2.5% added to your closing costs on top of closing costs, the majority of buyers aren't going to be able to do that. And then the market's going to have to adjust to figure out how can they get around that fee. So it's going to be a lot of people going straight to the listing agent, figuring out a deal to work with them as a dual agent, which I have pretty strong thoughts on dual agency because I don't know about you, it'd be pretty hard to properly represent two people that are financially motivated in the sale. So you're representing on the seller's fiduciary duty and the buyer's side's fiduciary duty while working within the middle. It's a very hard task to keeping things private between both sides. That can get a little convoluted and conflicting. Or on the buyer side, what could happen is I could see a lot of realtor loan officers. So the reason why I say that is because I could see loan officers that have dual license. So like, for instance, I have both licenses. I work as a lender, but I'm under the DRE, which is the Department of Real Estate it's the regulator for California. In California, you can be under the DRE or the DFPI as a lender. We're a mortgage broker, so we're under the DRE. You can choose both. My broker ended up choosing the DRE, but what I could see is I could see a bunch of loan officers turning into contract writers, right? So maybe there's just a small flat fee. They do the necessary disclosures, the residential purchase agreement, they sign up and they're ready to go.
Because traditionally, when you go to purchase a home, the seller pays for the listing agent's commission and the buyer's agent's commission. Now that the DOJ is involved, they're leaning towards decoupling commissions where the seller would pay for the listing agent's commission and the buyer would pay for the buyer agent commission. Honestly, with higher mortgage rates, higher home prices, and just everything that's happened over the last 5 years, I don't know how the average home buyer is going to afford being able to pay an additional 2 to 3% of the sales price of the home in closing cost on top of all the other closing costs that they have, including their down payment.
Right. Everyone's nickel and diming to buy a home in the first place. Everyone wants to buy real estate. They're either waiting because of rates, or there are people that are just trying to make it work. Like, for instance, I work with a lot of first-time home buyers. They usually have a little bit left over for various expenses like moving costs, various expenses on maybe a little bit new stuffs here and there for the kitchen, maybe a couple new sofas. The point is money's tight for a first-time home buyer. So adding that on top of it will just hurt the industry entirely. So it's curious to see how this will unfold.
With the average home price hovering around $400,000, you're talking about an additional $8,000 to $12,000 the buyer would have to fork out at closing for their agent's commission.
That seller was a buyer and they bought that home and they did not have to pay a buyer's agent fee. When they list the home, they pay the buyer's agent's fee. So it's always recycled unless you buy your first home and you never sell it again. So at the end of the day, it's always disclosed that it's not a requirement, but it's just been, you want to say the industry standard, but the way the contract's been written, there hasn't been any issues until this past year. So I'll be curious to see how it ends up going.
How much do I need to make to buy a $600,000 home?
Oh, let's go over it on paper. It's a little bit easier if I write it down. Okay, so $600,000 purchase price. This is 10% down. So for our principal, interest, taxes, and insurance, as well as mortgage insurance, it's gonna be about $4,295. So we're gonna multiply that by 2. So this is about $8,592. That's per month minimum that you need to make in order to afford that $600,000 house.
I understand where she's coming from. She's just trying to simplify the process. I'm just a very detail-oriented person, but I would assume if you're doing 10% down, you're probably doing a conventional loan. They probably have pretty good credit. I would probably not do ×2 because that's pretty much saying that your mortgage payment, your debt to income ratio can be 50%. Which it can be with a conventional loan, but you have to have compensating factors to go up to that limit. So the industry standard is 45% debt to income ratio with a conventional loan. So not exactly what I would do, but I think it kind of gives a general idea and metric. It just needs a little more detail on what the program is. Mortgages aren't black and white, and it's tough because I think like from my perspective, I'm so detail oriented. I want to do more short form videos like this, but it's hard to keep them within the required amount. I'm already rambling because I want to make sure I'm covering everything. But when it comes down to it, your scenario is going to be different. So for one, do a pre-qual. So in that conversation with a pre-qual is going to be over the phone traditionally or in person or over Zoom. What I'm going to ask you is, what's your gross monthly income? If you don't know and you're based off of hourly, I'm going to ask you what your rate of pay is and how many guaranteed hours are you. And from there, I can calculate your gross monthly income. I'll ask how much in monthly debt do you have ballpark, car payments, credit card payments, any other mortgages, stuff like that. I'll add that to the numbers itself. And then I will ask them what their credit score looks like and how much they have for a down payment. All those factors will help me determine a general idea of what interest rate. Then that'll give me a estimated monthly payment. It'll add to the total monthly debt that they have, and then divided by their gross monthly income will give me an idea of what they can qualify for. And then that will answer your question as to how much you can qualify for. If you really want to see what you can get an idea pre-qual wise, have a call, hop on a Zoom and get it detailed, because if you rely just on this, it may be a little bit misinformed, because for one, you don't need to put 10% down. And you need to understand the factors of what go into actually establishing a budget. And that's why the loan officer you work with is very important. So I hope that helps.
I finally understand why people hate buying a house. And I also understand why there are dads out there that think that loan officers and real estate agents are scummy. I get it now. I get it.
I've dealt with so many dads. It's so funny she mentioned that, because they're always very, very particular. They're always asking the big questions. And it's honestly a good thing. And I think I have an idea where she's going, but I want to know where she's talking about.
I had a conversation this morning with one of my TikTok buyers and with her dad as well. And after like several different questions on the interest rate and fees and down payment, like all this stuff, I just asked him, we'll call Mr. Smith, what was your experience like when you bought a house, and when was that? So he proceeded to tell me that it was in 2006, he sold his house and bought the house that they are currently in. And so I asked him, like, could you explain to me the process in which you went through with your loan officer?
They usually are a little bit, I don't want to say testy, but they have a little bit of attitude, and you got to put yourself in someone else's shoes. There's probably a reason why. So I always ask, what was your last experience like? And when was the last time you bought a home? And if it's prior to 2010, yeah, it's probably like a 70% chance you had a really weird experience.
So essentially he told me that he had to do his own research, because if he didn't, then the loan officer was trying to scam him out of like several thousands of dollars in fees. And then to make matters worse, when he brought it up to his real estate agent tried to convince him that all of those fees were normal, and that's just how much everything costs now.
That's crazy. And honestly, it's so true. Back in the day, my dad he's been in the industry for 40 years. And he told me the amount of stories that there was so much collusion between real estate agents and loan officers with appraisers, bribing appraisers to get certain values, working with agents and paying agents on the back end with kickbacks, vice versa for X amount of deals. Like, it's called RESPA. If you ever heard of RESPA, essentially it was created to avoid any sort of ethics violations or collusion or kickbacks. If you give me this, I'll give you this. If it's predetermined, that's called a kickback, and that is illegal, and you can absolutely put your license on the line. And it's a good thing, because back in the day, it was just the wild west of craziness when it came to lending.
And so I get it. Like, I get where there's an entire generation that thinks that we are scummy, because we were. At one point, we were scummy. Before 2008, before you had to follow all these very strict lending rules, people in this industry were very scummy. So I very openly say to a lot of my buyers who find me on TikTok, because I really talk to a lot of parents, and I just tell them, like, hey, in 2008, I was in 8th grade.
I think of the old school traditional dad that is not on social media really. He doesn't really understand TikTok, and his kid comes up to him and says, hey, I want to buy a house. I love this lender. I found her on TikTok, and he doesn't even know what that is. Trying to get over that hurdle and then also bringing credibility to your situation, that's got to be tough. So the fact that she works with so many buyers from TikTok is pretty impressive, because she's probably got her script down.
I studied it. I know what happened and I know why the crash occurred, but I wasn't a part of it. Okay. And second, even if I wanted to be that scummy, I just couldn't. Like, it would get to closing and I would try to add $5,000 in extra fees, and my closing team would be like, hey, this is violating XYZ. Like, I couldn't, even if I wanted to, but people don't know that.
There are still scummy lenders out there. A lot of the time it's on the front end. Most of the time it's going to be bait and switch. And I always say, have them provide a loan estimate that will just unveil all of what they're actually talking about and seeing what the real deal is. And if you're talking to a lender that you just get a good vibe with, and you're getting quoted higher fees from them, well, quoting higher rates or whatever, it's usually always the rate. But you feel comfortable, you feel like they're being forthcoming, but this other person, it's hard to pass up because you just keep hearing this amazing interest rate. These fees are much lower, but you haven't seen anything on paper. Have that loan officer that you just felt more comfortable with, take a look at that loan estimate. I guarantee you he's going to find something that is a little bit fishy.
So if there's like a little bit that I can do to put that hope that there are still good people in this world, and unfortunately a market like the one that we're seeing now where there is dramatic slowing down, hopefully filters out the real estate agents and the lenders that shouldn't be doing this or are still bad people and hiding fees. But even if those people are hiding fees, it's still not as much as it was before. However, I am hopeful that everybody's kind of voting with their dollar.
We've gone through such a long drought for so long. And if the loan officers and agents are still in the business now, there's probably a reason for it. They have a bit of resiliency. They are professional, and there's people continue to come back to them because they trust them. That says a lot about someone. So if they've been in the industry for more than a couple of years, like for instance, I've been in the industry for about 4 years, and I started in 2020. But it was weird because everyone thinks you do great in 2020. The rates were low, but as a young man in the industry, and then you have the lowest rates, and then how fast the rates jumped was the fastest in history. So if you find a realtor or a lender that's gone through both cycles of seeing the good and the bad and still in it during the bad, there's probably a reason for it, but still do your due diligence and talk to someone that you trust, and then probably work with someone that they're referring to you, because the person that you trust is someone to definitely listen to.
I'm hoping that people start to wake up a little bit and realize that it really is going to be the good loan officers that truly want to help people and feel good about that person being in that house at that payment, at that sales price, that stick around.
I can see where this video is going, but she touched on a point to where it's very fascinating. Online lenders, I don't know how they're still in business. I've had multiple situations to where I lost a client because of an online lender. And after they go through it, they always tell me it is what it is. But I kind of wish I went with you, because after that, after I locked the rate, it was I couldn't get people on the phone. They were in a different time zone. It makes sense. Work with someone local. And if you're not working with someone local, go with someone that you're getting referred to from someone you trust. It's everything. It's a big deal. And big box lenders and the ones that are dialing or online lenders, it's just the prioritization is to keep overhead low and to cast a larger net. So how do you cast a larger net? It's got to be enticing enough to get them on the phone or get them in the process. So it comes down to just being a good professional. Do your due diligence and work with a loan officer that knows what they're doing, and also the team that they have behind them. And they're not just by themselves on their own. That's another factor to consider too. If you're just working with a loan officer that's just processing their own loans and they handle everything, there are some loan officers that can do it, but I will say the ones that are going to have teams and they have people that handle the processing, and then you have your escrow team and you have your funders, it's going to make a big difference on the actual experience that you have. And also the loan officer is going to be able to not feel like they are always busy all the time. They're going to be able to answer your phone and be able to take the time and listen to your questions and answer them. So keep that in mind. I hope you guys found this helpful and insightful, and I'm looking forward to doing more of these, and I hope you guys all have a wonderful day, and I'll catch you in the next video.